international center, also has the potential to destabilize things. And we haven't exactly been, if you like, blameless in this. I mean, the level of gearing in Barclays and Standard Chartered is still very, very high. I can't remember what the figures are off the top of my head, but I mean, we're looking at all sort of nearly Japanese levels. HSBC less so. I think they're probably a bit under 30 times. But I mean, this is still ridiculoly high. HSBC has been criticized, and so has Standard and Chartered to a degree, about their links into China. And that has been seen as a risk. And I'm sure that those banks have taken steps to ensure that the liquidity on their balance sheets gives them at least some protection. But nonetheless, if you have to start writing things off, and this is to me, the big mistake in regulation, what the regulators have done is they've concentrated on how the balance sheet is structured, rather than looking at the relationship between total assets and equity, which is what any banker looks like when he gets frightened about economic conditions. I mean, all this sort of stuff about, Basel regulations and all the rest of it, it's all about, having liquidity in your funding side, or having it tied up on your funding side, and having loads of liquidity on the asset side. And that way, apparently, according to the Basel regulations, banks are systemically not risky. But it ignores the pressure on the management when they turn from greed to fear, when they stop expanding bank credit, when they see a bear market and they think, we've got to reduce our exposure to the markets. That is where the real risk comes from. And it seems to me that none of the regulators have actually taken this point on board.
And again, these numbers, I'm trying to relate this to something that people can understand. When these banks are heavily loaned into, say, commercial businesses, commercial real estate, other major loans that they have out as assets, they consider those to be assets. And then if those assets become non-performing because those businesses go bust, or the equity markets turn down. We've had anywhere from 15 to 30% downturn in the major markets over the past, just since the beginning of this year. But if these banks are leveraged 20 to 1, 30 to 1, 40 to 1 up, then it sounds like only a few percent of losses on their asset side makes them insolvent. Can you help people understand what that means? So what, can the bank just snap its fingers and recapitalize itself somehow? Or what's the magic trick that gets that to not be the start of a huge catastrophe?
Okay, well, there's several aspects to that question. I'll deal with the capitalization first. When the shares are at a substantial discount to their nominal value, in most jurisdictions, I think probably in all jurisdictions, under those circumstances, they cannot issue more shares. Now, the way this is got round is that you have a nominal share value which is close to zero, if you like, so you can issue shares at any price you like. But banks are very reluctant to do this, to dilute existing shareholders when the shares are trading in the market at significant discounts to book value. I mean, that bit is quite simple. When we look at falling markets, the situation is actually quite complex, because I've just been talking about, in the main anyway, about bonds. Bond yields rising, bond yield prices fall. In the Eurozone, the ECB has probably lost in the region of about 25 to 30% so far on its enormous holdings. When it comes to equities and also bonds in the commercial banking network, they use other methods to hedge risk. And this is why you've got things like credit default swaps, and you've got OTC options protecting you, so you can cap and collar, let us say, a position. There's all these sort of devices that help protect you from risk. if, let us say, the equity market falls another 20, 30%, then in theory anyway, banks don't necessarily fall over and die. I mean, they've got the problem that they will get non-performing loans because under those circumstances, I think you'll find that quite a lot of their borrowers will be in difficulty because they are essentially financial, things like hedge funds and so on and so forth. And they'll be forced into selling yet more stock into a falling market. But in theory, if they have taken out, if they've hedged their risk in the futures market or the forwards market, then they might feel that they're relatively well insulated. And I'm sure they'll make the returns to the central banks on that basis. But this assumes that your counterparties don't fail. If you have a failure in your counterparties...
Yeah, don't worry, I've got insurance. Oops, there goes the insurance, my counterparty.
Yeah, exactly. That's right. Now, the insurance isn't with AIG or someone like that. The insurance is with Deutsche Bank or BNP or one of those guys in the Eurozone, or perhaps the Japanese banks. And so you can see that suddenly all this protection isn't necessarily there. So, I mean, really what we're looking at, I think we're on the edge of a huge, great financial mess. That's the only way to describe it. And of course, everybody in the systems, they're not really looking at this. They're only looking at, what's going on in the market. Is it going up, down? What's the Fed going to do with interest rates this afternoon? Is it 0.75% or whatever? Who cares? The problem is far bigger than that. It really is. And you referred to the bounce in the bonds. I mean, to me, I would say that given the very sharp rise in bond yields in the last few days, to have a bit of a sort of clawback ahead of the announcement, which everybody's frightened of, makes sense because, I mean, people who will have shorted US Treasuries will be buying them back because they don't want to take the risk of losing a profit over the uncertainties of a Fed announcement. So I can see why it is that yields have, after rising very sharply, have come off. And I think, to my mind, that is a better explanation than someone with big boots has walked in and supported the market. I wouldn't rule that out. And I wouldn't rule the Exchange Stabilization Fund, which was set up in 1934, basically to manage the gold price, but it manages everything, I think, that it's told to manage. And it works out of the Fed's offices anyway, even though it's a department of the Treasury. I can see them maybe intervening in these markets. That wouldn't surprise me at all. But on the face of it, I mean, what we're seeing is we're seeing a technical bounce ahead of an announcement. What happens there after that? I should think after a brief pause, I should think markets will continue on down because it does not address this fundamental problem